Hi and welcome to the next episode of FINtastic Talks. And as always, let me start with gratitude. Thank you for taking out time to be watching these talks, and I hope that we are being able to play a role in helping you be more prosperous and help you create more money. And that's the whole purpose. That my belief in life is retirement is not the end; it is the beginning. So you need to live the life you deserve. For that, you need to unretire. There needs to be one time when your second income, is becomes more than your current income, so that you can afford to live a life that where you can choose to do anything you want. You can travel anywhere you want to go, and for that, you have to look at your investments like a business, and everybody needs to be separate. Like a Sanjiv Bajaj needs to be separate, and Sanjiv Bajaj Investments needs to be a separate business as itself, and you have to manage it like a business and ensure you do the best. So, guys, it's great to have all of you. And I know there was we have just closed the last financial year, and the year finished with a craze for life insurances, the guaranteed return plans, and so they were giving very good returns, and those people who were able to take advantage of getting tax-free returns for the next 30 years, great, you have done an awesome job. And my sincere belief, nobody can predict, is in the long term interest rates will fall, and you'll come out as very smart people who took the right decisions. For those who even didn't buy, you still have a 5 lakh rupee window that you can buy a guaranteed return plan up to 5 lakh rupees, which will be tax free. And just that there's a lot of confusion that last time people were asking a question that if you buy a term insurance or ULIP, is it a part of the same kitty? No, those will be considered separately. So it will not prevent you from buying a ULIP plan. And just to clarify that even if you buy a taxable plan, any claim paid, that section 1010D on a death claim remains valid. So if any money is paid as a death claim, it will continue to be tax free. So I hope this is able to clarify. But today we have a very different topic. We are going to be doing a deep dive onto AIFs. So we have with us Anunaya, who's known for from India Infoline Asset Management, and they are known for their AIFs in addition to the mutual fund. And we want to deep dive into the topic of what is the difference between AIF and mutual fund. Are they the same products with a different name, or is there a different philosophy? When should we choose what product, and what will be better for our portfolio, and who will it be better for? So let's get into these questions. So without further ado, I would like to call Anunaya to join us today. Hi and
Yeah,
welcome, Ananya. It's great to have you with us. So let me
thank
introduce
you.
Ananya is a hardcore mutual fund guy and who's played various roles. And today he's playing a very unique role where he's got a combination of mutual fund come AIFs. So, Ananya, one of the things I wanted to take up, as I was telling, there are a lot of investors who have this question between mutual fund versus AIF or AIF versus mutual funds, and they truly cannot understand the difference. And this, I'm saying, this happens to me also. Because so when somebody presents to me an AIF, I say, okay, but what's the difference between this and a mutual fund? Why couldn't you do it in a mutual fund? In fact, yesterday I was spending some time with a fund manager who had come up with a very differentiated proposition in an AIF. So my whole questioning to him was that why does it need to be done on an AIF platform? Why can't it be done on a mutual fund platform? So before we get into that, Anunya, we like to start by understanding the people who are on this show. So, so today you are the president of India Infoline Asset Management. Please tell us your story. And we want you to start with your childhood, your parents, and how you got into this industry. And then we take it from there.
Sure. Thanks, Sanjeev. A very good evening to everyone, and yeah, I think it feels really good to be part of this show. It's one of the wonderful platforms, Sanjeev, that you have created, where at least you get the industry people to come and interact and express themselves, which is in the interest of larger audience. Regarding me, if I have to talk about, I think I hail from a small town called Chandigarh. Well, Chandigarh has its own uniqueness. One of the unique part of the Chandigarh is it's the only planned city, if we can talk about in the country, being planned by a French architect, Mr. Lee Corbusier. So have spent my entire childhood over there, schooling, college, and then I started my professional journey uh, from Delhi with an NBFC called Tata Finance, and that's the only time when I was actually outside the purview of a banking, because thereafter I became a hardcore banker. Joined IDBI, worked for Citi, ABN, RBS, uh, and across the journey of my banking, I have been one of the very fortunate one who got an opportunity or an exposure to work across the segment, across the streams. I think only stream which I haven't worked in the banking parlance is the treasury, where I haven't got a chance to work. Otherwise, I have done the corporate banking, I have done trade finance, I have done operations, risk, you know, and the wealth management. So, and my last stint was in Bangalore when I was working for RBS as heading the Bangalore unit for them. As the destiny always says, when you are a wealth part of the business, you are managing people's money. There is always something which is in your mind to get to know, how does the other part of the world functions? As you were mentioning, many of the questions which do come in people's mind, AIF versus PMS versus mutual fund. But at the end of the day, how do the manufacturer really work? And that was something which was obviously bothering me as well, and that resulted into me transiting from a wealth manager, being one of you, to a manufacturer, and started and moved into a transition into a journey with DSP BlackRock when I was the head of strategy for them, and the journey continued with Invesco and currently with IIFL. One thing, Sanjeev, if I look back in my 26, 27 years of a career, I've always believed in one thing, that the moment you get a feel that now you are stepping into a comfort zone, I think that's the day you should start getting worried. So what I have, at least, as I say, I have been a fortunate one. What I could manage to do is transitioned from a corporate banker with IDBI, moved into retail banking with Citi, moved into wealth management with ABN and RBS, moved into asset management as a head of strategy with a BlackRock, head of business with Invesco, and now head of business with IIFL. And the difference between Invesco and IIFL again is very, very prominent one. Why? Because Invesco was largely a mutual fund house, and IIFL is an alternate specialist. So even if it was a head of business on both the sides, but the nature of businesses were very, very different. So I think that's something which always had kept me up on my toes, and I would love to take these kind of challenges.
So Anunaya,
Regarding my
let me
family
add to
background,
this. Yeah.
sorry.
So here, just adding to that, a lot of people are very scared of making a change in life. They
Yeah,
want to stay in their comfort zone. So what would you like to tell them that and whenever we start something new,
yeah.
initially it is very, very tough. So so what would you like to tell them?
See, only simple thing, when you go to the bed in the night and when you, before closing your eyes, just talk to yourself one question. Have you been able to add anything to you through the day? Anything which is content, which can add to your personality, which can give you some bit of upskilling? If the answer is yes, please have a peaceful sleep. If the answer is no, you should not be sleeping in that night, because of, if you sleep, then believe you me, you are letting multiple things go away. It's like very simple, Sanjeev. We all have seen world, and when we start our professional career, at the end of the career is nothing but a pyramid. When we start our careers, we are thousands of people right at the base of the pyramid. But when you start moving up, at the end of the day, Sanjeev Bajaj is only one. So if you want to be Sanjeev's shoes, if you aspire to become a Sanjeev, then you will keep on adding value to yourself. You have to keep adding skills to yourself, and you have to ensure that your earnings per share should be moving up so that you get a better multiplier and your market value goes up. So otherwise, you are going to get redundant very soon.
And let me just tell you my own experience. Whenever you do something new, you feel I'm not going to be able to do it. ये तो कभी नहीं समझ आएगा. This I will never understand. This is something which is beyond me. But one thing, my father taught me is persistence. He said, look, whenever you're not even understanding anything or something is beyond you, just keep doing it. And I realized that one day, I can't imagine that why I ever even thought that this was tough or this was difficult. It's like driving a car. When the first time a person drives a car, he says, I'm never going to be able to do it. This is so difficult. So many things to see. And now, once you have had experience when you're driving a car, you don't even know you're driving a car.
Yeah.
Everything seems to come automatic. And same thing happens with a role. So, guys, persistence is the key. And that's what Ananya is saying, that never be satisfied with where you have reached. Always imagine that you can do more, and for that you don't have to dream of what you have to do more. You just have to have persistence in doing it well. If you keep doing it well, you will win. So Ananya, coming back to your family, so I see there are a lot of people from Chandigarh. I can see one Meena Kapoor. She's saying, "Wow, I'm from Chandigarh." So many other people. So just tell us a little bit about your family.
Oh, yes, I think regarding my father, if I have to start with him, I think he has been a management consultant working for a company called ABC Consultants. And he had been through and through in his life being a management consultant, giving advisories to various corporates. Now he enjoys a retired life. I have a brother who's a managing director with the company Accenture, and he's one of the youngest MD of the company as we talk today. My wife is a certified Q math teacher. She loves coaching and coaching kids, so she has her own passion of being in this side. Two kids. My daughter is in class 10th. She just had given the exam of class 10th. My son has completed his plus two. Now he is applying. He's appearing for engineering test. Has just finished his JEE mains. So two kids. That's a small family we are.
Superb. So, Anunya, getting to our topic today, AIF versus mutual funds. So, this is a question that one is a minimum 1 crore ticket size, but also what is the difference between an AIF and a mutual fund, and when should a person look for an AIF? When should a person look for a mutual fund?
No, I think great question, Sanjeev. I think the contribution amount, the very fact that the contribution amount in a mutual fund is 500, PMS is 50 lakhs, and AI becomes 10 million, which is 1 crore. That itself will give you some bit of a sense why the difference. The difference is also on the risk assessment that one has to go through. And the risk could be multiple. It could be the risk of liquidity, the risk of interest rate, the risk of the asset onboarding that you are doing. And the risks are not something which is understood by a common man so easily, which is where when you are in the business of wealth creation, you should always start with the simple. Simplicity comes in the form of a mutual fund. It's a pool of money that you give it to the fund manager. There is an objective that a fund has very clearly defined. You exactly know how the wealth, what is the way the funds are getting managed. You can start with a lump sum or an SIP or an as you get into the wealth creation, you have got a money as when you should start moving up the ladder in a PMS and an AIF. Now, when I say risks are different, obviously risks are different. Why? Because the propositions are very different. See, AIF normally comes in three categories: Cat 1, Cat 2, Cat 3. Cat 1 is something which is for institutions, so let's not get into that right now. Cat 2 and a Cat 3 are more prominent one that we people see people investing, the common man looking at investing the money. Cat 2 actually allows you to get access to unlisted private equity, structured credits, InvITs, REITs. That's the world. Now that world is a very, very complex world, very complicated world. It might looks like a word, but the thing which goes behind in the structuring a deal or looking at an InvIT, what are the assets in the InvIT? Those are a lot of complications. But with the complications, as we all know, the law of economics holds good with everybody. Higher your ability to onboard the risk is where the rewards are going to be better. So obviously, if in a mutual fund on a debt side, you can see a decent return between 8 or 10% kind of a number. Here, depending upon a structuring, how the structuring has been done, you can actually look at a return of between 14 to 15%. Now, through an InvIT, you can look at both the benefits, while your returns are coming into you in the form of interest through the coupons and all, and you can also through the capital gain, you can have an equity taxation. So there are a lot of combination permutation that we can keep looking at in the Cat 2. Cat 2 also give you an access to private equity, unlisted space, which normally as a common man very difficult to get into. But this also come with a liquidity risk. Practically liquidity is not there. So that's where the key differentiators do come in. On a category 3, I can still agree with for a moment with few of our audience which is there that look, in a mutual fund, if I am managing a long only part of the portfolio, then how does it differ from a category 3 AIF and all? Maybe that can be still debated because a lot of flexibility on the concentration risk that you can draw in an AIF, which you are not allowed in a mutual fund. So still you have those things to work on. But at the end of the day, I would still say maybe some bit of a commonality you can draw between a mutual fund and a cat 3. But other than that, they are very different. And the difference also comes with a form of risk, which either liquidity or a return or a time risk that one has to onboard.
Yeah, Anunya, I think very well explained. I think this is one of the best explanations. So, category one is basically small company, angel funds, very high risk, can have very high returns. So they are aiming for a 25 to 30%, but obviously it can also go negative. Category two is something between a category one and a category three, which is a public market fund, and category three is a public, mainly a public market with derivatives and all. So I think that's very well explained. And guys, it's all about the returns. High risk, higher returns. So a mutual fund, you can look at 8 to 12% depending on the fund that you choose and how the country grows in the next 15, 20 years. It can be higher also. In last 20 years has been much higher and much better. So, but whereas AIF is looking at taking higher risk to be able to give you a higher return. So it can also give you a higher loss. And for those who don't understand AIF, because we do understand that there are a lot of people who are new here. So AIF stands for Alternative Investment Funds. So it's another category of pooled investments, which but these are meant for more HNI or more advanced investors who want to take a higher amount of risk, and that's what they are about. So again, when we come to this, when we are discussing this topic, another very important question, and especially when we talk about retail investor, there's a lady called Manisha. She is also asking this question between long term investments, active versus passive investment strategy. So, Anunya, what would you like to say here?
My response, Sanjeev, would be that one shouldn't be saying active versus passive. I think one should start talking a language is active and passive. Because the times, the way that we are migrating, see, we are talking about getting into the scenario where our mutual fund space itself is now close to 20 to 25 lakh crores. So as we grow further, you will see the active alpha creations going ahead would not be that easy. Beating the benchmarks would not be that easy. Now, when we are looking at building the portfolios, we should, in fact, I have a little bit of a different view, and when we do our asset allocations, assuming that you have decided a money that should go into equity, debt, commodities, let's leave the last two part, let's stick into equity. I feel equity should ideally be distributed into three parts. One is an active funds, which is normal fund that you see, which is getting managed through active management by the fund managers. Passives, or we also call them smart betas, where where you from then model and all, you can manage it. I feel that a third category, what also one should look at is active with a hedge. Because at the end of the day, active or passive is only allowing you to participate in the market when you are moving unidirectional market. When the markets are in the positive zone, that is contributing to your returns. Once the market starts getting anxious, getting to drawdown scenarios, then by virtue of being a mere spectator, you actually cannot do anything else. At best, what you can do is take the money out, but that's not a solution. There are enough sciences which has proven cash is a bigger drag on the portfolio return rather than your drawdown scenarios. So what I suggest is, in fact, something that we have created a portfolio and we are very, very positive about it, is that can I have a portfolio which is active with a hedge? I'm talking about I will create a hedge by buying some options in the portfolio. and that option will allow me to only create protection in the downside market. So I would rather say, keeping the discussion between active and a passive, one should look at active, passive, and an active with a hedge. There is a science to have all the three categories, rather than we should not be competing with each other. They all are complementing each of them, and you should decide how much would you want to keep in active, how much are passive, and how much with active with a hedge, depending upon what is the risk appetite that a client do have, how much is the client, what is the time horizon that a client has, and how easy, what is the return expectation that he's looking at building it.
Yeah. So, and also let me add, Manisha, see, it also depends on your type of the fund. See, I believe passive is very good if you're going for a blue chip fund or you're going for Nifty 50. So these are the 50 big companies. So you are just banking on those companies. So they are an active manager, beyond the level. If you're taking a diversified blue chip fund and a passive fund, they may not be a huge value add that you can get from a fund manager. But when you're looking at a flexi cap, okay, so a flexi cap is a fund manager who can move between large cap, mid cap, and a small cap. That's where active is better, because there you're banking on a fund manager being able to make the right calls. Like example is that, look, if you are invested in a fund, then on a passive fund, then you're buying into an index, and there are companies which go out of index because they are not performing, and there are companies which come into index because they perform so well, and you have missed all this.
Yeah.
Okay, so when we talk about small cap, mid cap, flexi caps, it is better to be in active, better to be in a, and go with a good wealth management company which has the ability to predict who's going to do well in the next 3 years. Now, there are a lot of people who make this mistake on investing on ratings or past performance. Look, if my strategy has worked for the last 2 years, it's not going to work for the next 2 years. Okay, and that we have seen. No strategy keeps working perpetually. Pehle there was a diverse, they were concentrated growth funds which are doing very well. These are people out of the 50 top stocks, they were investing in 17, 18. And they were the where all the movement was happening. Then what happened? The broader index started doing well. And these companies had outgrown, so they had stopped performing. Okay? So these things keep changing. You have to predict what is going to work in the next 1, 2, 3 years, and that's where the research people come into play, who talk to the fund managers, see who's got the right thing, what is the logic, is the logic making sense or not. They're able to bring that to you through the wealth manager, and then you can take a more proactive call that, look, this is something that I'm going to be doing for the next couple of months or next couple of years. Like we had last time, I think in a couple of talks before, we had talked about Nasdaq. That is Nasdaq well priced at that time, and US tech stocks have actually done well in the last 1 quarter. But nobody can predict. This can go right, this can go wrong.
Yeah.
So look, if you are looking at, so I think, as an investor, you need to have small cap, mid caps, and large caps in your portfolio. For small cap, mid cap, I'll prefer active funds. For a large cap, I can look at a passive fund or an active fund, depending on what I want. Okay, if I want a concentrated portfolio, then an active fund is better. If I want a diversified portfolio, then a passive fund is better. So this is what I would like to say to you. And but they are always, for anything, there are so many permutations and combinations. Okay. So Anshu Rajput is asking a question that Anunaya, that what is the calls your mutual fund is taking? Are there any large cap opportunities in the which are sort of value priced? So is it a good time? Like broadly, let me ask you: is it a good time to get into large cap fund? Which type of fund would you recommend? I don't think you'll be able to comment on specific stocks, or maybe you can talk about some sectors if you want to.
No, I think Sanjeev. In fact, we have a focused equity fund, which is in a way cannot have more than 30 stocks into the portfolio. The fund, that the way we are managing is, it has 60% of a large cap, 40% of the non-large as a space. So so when you are building, and you very appropriately, you just said, which is, In a large cap, if you are only in a large cap space, very difficult for you to build differentiators, because at the end of the day, active weight management is the only thing which can make you do a little bit of up and down. Otherwise, no other thing that you can add. So the value in a true sense is actually outside the purview of top 100, which is where you can have the bottom pickups, bottom up approaches that you can do, and you can pick the right stocks, and which is exactly what we have done. Our focused equity, which is the fund that we are having, has a 60-65% large cap, and rest all is the non-large space. From a value side, I think we still feel that as a sector, we are very, very upbeat on a banking as a sector. We feel that banks, by virtue of the cleanup in the balance sheet that they have done, if I just give you some numbers, in by 2018, if I'm not wrong, the NPA should be close to 11.2%. Now look at the NPA numbers. We are at a 5.5. We have just halved from what we were, see, by 2018. In the same year, if I look at my CAR number, capital adequacy ratio, it was close to 13%. Today we have a capital adequacy ratio of 17%. If I look at my own capex plans, we are actually back to pre-COVID levels. So what I'm trying to say is, from a sectoral perspective, we are very, very bullish on a banking. What the banking, one thing which has come up as a difference is the financial inclusion, which has, through the Jandhan, which has happened, has created a strata, the lower end of the curve, which is yet to consume. And that strata is going to be a massive fillip to the entire banking sector on the retail piece, which is where you would see many banks today are transiting from a wholesale orientation to the retail orientation, because that strata is huge, which is coming up. We are very, very positive on auto, and more in an auto, we are very positive on electric vehicle segment. On an EV segment, we feel it's a great segment to be in. The penetration levels are hardly anything yet. After doing all of this, I think what used to be close to sub 1, with close to 0.7% by 2019, is just 4.7% today. But what it has done is, by virtue of PLI that the government has introduced, I think that's been a great, great boon for the auto sector. The entire capex, or that OEM sectors and all that is bringing it up. We are talking about, in India alone, an opportunity close to $15 billion of investments happening, or a capex happening, in next 5 to 7 years. So that sector is moving up very well. We are very positive on defense as a sector. Discretionary consumption, we are positive on, but then that also has run up significantly. So we need to be little selective in our picks, the way we are doing it. I think the market that we are in today, it's an extremely bottom-up market, rather than being a sectoral preferences where we have or where we do not have. What we are very, very clear about is that it's a completely bottom up, and bottom up stock selection lead to a portfolio, and then you can draw your inferences saying, okay, fine, look, I have a banking as a. But the reality is, 1/3 of the market today is governed by the banks. That's also fact. So that's where I would rest my comment.
Yeah, I think very well said. So I'm sure banking is a opportunity, but you have to look at the value of the stocks, because Indian banking is in a much safer place than compared to US. You're just explaining what has happened there is that the yields on the treasury has gone up drastically, and there's a concept called mark to market, and mark to market has caused the returns to fall drastically for the banks and their assets, that the security margins they are creating, which has created that global banking crisis. Obviously, it will have some impact on India, but that is giving you an opportunity to buy. I am personally again bullish on IT sector. I think there's a lot of pain in that sector for the next couple of months. But if you want to come into it through a systematic, and that's personally what I'm doing. It may work, it may not work. But I'm right now entering technology on a systematic basis, because I believe technology is going to deliver returns. I'm also looking at defense tech. Okay, so again, not the traditional companies, but some of them are overpriced. I think that because that's with made in India, that's one sector that's going to become big. And there is also manufacturing which is coming into India, the tech manufacturing. So if you are able to identify the right companies, obviously we can't talk about companies, and that's where the fund managers, and that's why you need BajajCapital to help you find the right fund. So that is what it's about. Next is there's a lady called Tanya. She's asking a very interesting question that how do I balance my short-term liquidity needs with long-term investment goals? So Ananya, this is a I have my own views, but I would like to start with yours.
So you can do it, when you are doing strategy. I think that's where some bit of it you can build in. But at the end of the day, yes, you are looking for a compounders, and compounding will happen over a long term investments only. What I suggest is there is a concept called systematic withdrawal. That is something that you can exercise as an option, wherein you can look at how since when you want the liquidity to start coming in. There is something called a hybrid funds, like MIPs and all, which gives you a systematic liquidity by virtue of having a large part of the money invested in the debt, and some part of the money, depending upon whether it falls in a conservative, moderate, or an aggressive MIP, then that's going to decide how much of equity allocation would be there. So that's another way that you can look at it. Uh, well, I'm just assuming that there are few clients who have an interest in AIFs as well. In the structured notes to the PTCs, we can structure a deal in such a way that on an every month there is some kind of a distribution which is happening. So there are multiple ways of doing it, but it's at the end of the day, ma'am, what I would suggest to you is everything boils down to what kind of risk are you looking at onboarding. When do you need a liquidity? Do you have a 5 year from now and then you want a withdrawal as a concept to come in, or you need a liquidity right from a day zero? I think there are a lot of questions that needs to be answered, basis which you can actually decide what kind of asset that you want to onboard, and how do you want the liquidity to get delivered to you. So I think that's where I would suggest.
Yeah, I think Nunya has answered it very well. So, what I like to say, Tanya, whenever you're confused by balance advantage. So, point is that so a lot of us, just for the sake of short-term liquidity, unless we are sure we need that money, then we keep it in liquid fund or something like that. My point is that what I tell people, invest as if you're investing for the long run, because mutual funds anyway have liquidity unless you're going in for an insurance or something where you're going to have a lock-in, like we talked about guaranteed return plans. There you have to be very careful. There is a lock-in. You're going to lose money if you want to exit. And there are a lot of questions on AIF exit rules also that we will cover later. But point is that, look, even on a equity fund, you may end up paying at max 1% or half a percent exit load. It doesn't matter if you need the money in emergency. But most of the times we don't need this money. And we have a 10, 12-year horizon, but we just keep thinking for the sake of short term. We never built a long term portfolio. So my point is invest. And even if I have money, I invest it in equity because I assume I will not need this money. If I need it, I withdraw it and I pay the exit load. But it always generally gives me a better return. Otherwise, my second thing is balance advantage. And when I definitely know I need this money for a shorter term, then I'll go for a target maturity plan or a liquid fund. That's how you take that call. So I hope this is able to ask help. So Ananya, next is that a lot of questions on AIFs. That what are the exit loads on AIF? What is people say AIFs are not that liquid. What does that mean? Category three AIF, are they liquid? Are they not liquid?
See, Sanjeev, category 3 AI, by virtue of investment getting done in the public listed, universe, liquidity is there. What we normally do is that, you don't actually, there are multiple ways of entering into a fund. You don't necessarily need to commit money on a day zero. You can actually commit money over next, four installments, quarterly payouts over next 4 quarters, and then you commit the 100% of the money in a ratio of 25% each. What we normally do is till the
Yeah, so
time you're
just to
100%
clarify,
committed.
most of the funds, guys, if you are committing 1 crore, you don't have to pay 1 crore immediately. You can be paying 25 lakh rupees over a
Yeah.
period of time.
So what we normally do is the liquidity is not available till the time your commitment is done. So if you have given the money on a day zero to me, then it's fine. If you haven't, then we will wait for your commitment to get over. After that, generally, because we want to, in the good practice, we want the money to stay at least for a year. So what you will normally see, every fund in a category 3, Post your 100% commitments are done. 1 year, the monies are not available to be touched. The liquidity is zero. Thereafter, in a differentiated exit loads, whether it's a 3 year, 4 year, 5 year, you can pay an exit load and take the money out. Easy to do. Why? Because it's a listed space, public market, you can do it. But the moment I come to category two, whether I am in a structured credit space, whether I'm in an InvIT, I'm in a REIT, or I'm in a private equity, in either of the four options that I just have mentioned, the liquidity practically is zero because there is no way you can exit. That's the way the structuring gets done. So be prepared if you are looking at a category three, maybe with a shortened liquidity not being available to you. Shortened period could be a 1 year. Thereafter, monies are available at a differentiated exit loads. But practically in a cat two funds, until and unless I decide to wind up some strategy and repay the money back to you, the liquidity practically is not there.
Yeah, understood. Okay. So, taking on the next question, that Motilal Oswal had done a lot of advertising around buy right, sit tight. That has gone into people's mind. So people are asking that what do you feel about buy right, sit tight philosophy, and as an investing principle, and what are the potential benefits and drawbacks?
Just give me one sec, please.
Yeah. So, answering this question, Ramesh, point is that buy right, sit right is a good philosophy. That look, when you invest in stocks, you need to invest for the long run. But also, you have to be very careful. The company that is existing today may not exist tomorrow. Because so you also have to see whether this company is innovative, it is moving with time, it is still remaining relevant, it has prices not run up crazily. There have been some amazing tech stocks whose price became so overpriced for the next 10, 15 years, you virtually got no return being invested in that company, despite that company being a great company. I don't want to take names. So point is that buy right, sit tight. My point is that unless you have couple of specific stocks you are very bullish on, do it there. Otherwise, go for a mutual fund. Let the professional fund manager do it for you. See, compared to US and all, there are so many funds, so many this thing, and the markets, the information is much better. Their passives or algo based funds can do well. In India, it's still about a lot of gut call, lot of hardcore work to be done on the ground, and that's where a fund manager has a great role. So I believe that go have a good wealth manager, pay the price. Okay, because there are people who are discount seekers, there are people who are premium seekers. For a wealth manager, how much are you paying? You're paying 0.75 points. You should know it. Okay, look, I'm paying 0.75, and whenever you review with the wealth manager and say, what is the value you're adding to me? Are you being able to create an additional return over, if he's able to create a 2% additional return and he's able to show it to you, then ठीक है, you have still got 1.25% extra. As they say, pay peanuts, you'll get monkeys. All of you are professionals. If your company doesn't pay you, you're not going to do a great job. So that's my view. Anunya, I'll let you add to this.
No, sure. I think Sanjeev, you have really mentioned it very well. You explained it pretty well. See, to me, at the end of the day, why do we look at buying a stock? We look at buying a stock because we are looking at a consistent compounders. That's the only way wealth gets created. In a journey of consistent compounder, we also need to be very, very careful in our mind is the what valuation am I paying for it? And hence, I don't think that you can literally sleep over a stock for ages and ages, and you can actually, you can follow the Hero Honda tagline, which is fill it, shut it, and forget it. That really works. You would need to be dynamic in your approach. You need to assess the companies when we go and talk to the people like Sanjeev. We need to understand how the companies are faring, and that's where we will keep, deciding whether we should hold on to the stock or we should not. Please appreciate the very fact this is a service which is a full-time job of the professionals. They have an access to so much of information that as a common man, none of us can, even if we are giving 100% of our time, it is very, very difficult to get access to the kind of information that the investment team of the respective mutual fund houses do have. And hence, even if you are a long term investor, you would have heard multiple stories of Dadaji ka trunk khula and we found a Procter and Gamble stock and then it has become a multiple baggers. Yes, it does happen. I'm not saying it doesn't. But if those were not the days when you had the professional services of the investment manager and the advisors who can guide you, today you have it. Why do you want to take a risk? Unfortunately, I can't name the stock, but we know one of the uh, you know very prominent IT company disappeared overnight. Nothing wrong. We were all talking about this being one of the best companies in the country, and then we got to know what was going on inside. No, please be wary of the fact this is the real world. What is visible to you is only visible to you, but you need to go beyond and see what is not visible to you. And for that to happen, you need the services of the professionals, and the job of identifying those professionals is the job of the team, which is led by Sanjiv. He exactly does the due diligence on the managers, identify a right manager. Once he identifies him, then he allows that manager's product to get showcased through his distribution network.
Yeah, and the way we control it, guys, is that look, this is us and other distributors also. Let me say that my own research softwares cost me more than a crore rupees a year, and I'm not a fund manager. Okay, so it's not a very cheap. It's not that anybody and everybody can do it. You know, and we have a team. I'm not even talking about my team cost. I have a team of 10 to 11 people who are doing this research. On that basis, we come with this select list concept where we say that look, in this category, these five funds are likely to be the top quartile for the next 1 year, 2 years, 3 years. And obviously, see, things can go wrong. Nobody can predict 100% accuracy. But what we have been able to see that if we compare with the top 50% quartile, what we compare is that if you are invested in a passive fund in the top 50% quartile, has our advice been able to give you a alpha over that? That means additional returns over that. And most of the times today we are giving about 1.5 to 2% sort of an additional returns depending on the horizon. So that's why I'm saying question your wealth manager how you are adding value to me rather than not having a wealth manager, and buy right, sit tight, do it in limited stocks, and remaining use a mutual fund.
Sure.
Sachin is asking a question. I know we have, I'm very having a very interesting conversation, and I can see the quality of questions that have come in. We may not be able to answer all, but it's great to see that how informed this audience is today. So Sachin is asking that what is an ideal horizon for a SIP for an optimal return? Anunya, can I answer that so that we can move on? So
Yeah, please.
my point is that minimum 10 to 15 years. If you really want to see good returns and power of compounding, be there for 15 years, minimum 10 years. Anunya, anything you like to add?
No, I think you said it very correctly. I think that's the bare minimum. Get early into investing habit and stay long. I think that's the mantra if you really want to create a horizon, a wealth that is what your wish is. Get early and stay long.
Yeah. And then Yatin is asking us a question that how do I diversify across various mutual funds to optimize my investment time horizon and reduce risk?
Yeah, I think it's a good question. You need to understand how the risk matrix works. The large caps, by virtue of being the most predictable businesses, the element of risk is quite contained. And because of the element of risk is quite contained, obviously you are looking at a compounder which comes to between 10 to 12% kind of a return that you can expect. As you go down the ladder on the risk and start moving from a top 100 to mid cap or a small cap, that's when your element of risk goes up. And with the element of risk, obviously your ability to generate returns also moves up significantly. Now your question is how can I can use diversification across mutual funds. At the end of the day, we are in the business of managing people's money. What can work well for an 18-year-old kid will not work well for a 60-year-old gentleman. So first of all, you have to do the profiling of a client. After doing the profiling of a client, you need to understand what his risk assessment parameters are, what are his return expectation, what is the time horizon that he has in mind, and after doing that is when you can decide whether to the millennials or a very young guy, you may keep the component on the flexi or a mid or a small, slightly on a higher side. But an elderly person, you would need to build more hedge to the portfolio, which will come in the form of a equity, which is the large caps and all. And I'm talking about equity alone right now, because the world doesn't end with equity alone. When we talk about a diversification, it's also asset class diversification, it's also geographical diversification that one has to look at. So you have to then see how within equity you function. Then you have to look at within equity, this is the way I have done it. Outside equity purview, how am I doing it now? So then you have to decide in the debt how much of the duration that you want to onboard, because duration also comes with an element of risk to it. How much of money would you want to keep it money at call, which is the liquid funds and all? Do you want to look at a geographical diversification outside India? Which country would you want to take it? So all of this comes into account. And to be very honest, Yatin, there is no one answer that I can give it to you. It's a function of what the client's profiles are. But yes, you can do diversification across the mutual funds through, as I said, a market cap diversification. You can do a asset class diversification, and you can also do a geographical diversification.
Yeah, and it all depends on age, as Anunya said. And I'll just make it simple. I'll give you my own example. So for me, 20% of my portfolio has to be in small caps, 20% in mid caps, and I keep another 20 to 30% in flexi cap and 30% in large cap. That's the kind of portfolio I've created for myself, because I want to be slightly aggressive, get higher risk. When I'm in flexi cap or a large cap alone, then my average return is about 11% in the long run. But when I go for a small and a mid cap, I can even get 16, 17% return in the longer run. So that's how I built my portfolio. So it depends on what are your needs. So next question that Pandi is asking this question, that what are the risks associated with AIF in terms of regulations? So I would like to say, Pandit, regulations are changing, but they are always changed for the betterment of the investor. So as an investor, you don't need to worry about. Because I don't think there's anything to worry about on AIFs. Anunya, let me add to this question that what are the good AIFs under IIFL umbrella today that you recommend to our viewers today? You're on mute, I guess.
Yeah, my bad. So thanks, Sanjeev, for asking this question. I started off saying that when we look at equity space, it should be put into three parts: uh, active, passive, and active with a hedge. Now, active with a hedge is a very, very unique proposition that only we in the industry are currently offering to our investors. What are we simply saying? See, as the market becomes expensive on a price to book, the probability of a market showing these signs of drawdown starts increasing. And that is the time when you need to protect the portfolio by building a hedge. We are simply saying, we will buy the options of the Nifty 50 depending upon where the market price to book is, and that Nifty 50 hedge through the put is going to ensure that your journey in the equity market smoothens if the markets in times ahead are going to be volatile. So our view is, we are entering into election year. As we are getting into election year, the volatility is one friend which is going to stay with you and for a reasonably long time. It's a great time when you need to have the portfolio, something in your client's portfolio where the portfolio can participate on both the sides of the journey. Market moves up and the market comes down. I think my fund, which is an IIFL Equity Opportunity Fund Series 2, is a very, very unique fund which allows you participation both on the long side of the portfolio when the markets are moving upwards, and by virtue of having a derivative which is puts option, it allows you on the downside as well. I think that's the fund I will recommend to the audience.
Right. Thank you, Anunya. So we'll definitely look at this fund, and you know, and let me tell you, it's one of the most popular AIFs, and
Yeah.
it's doing extremely well.
And it's a
So
part of
going,
your advisory list as well, Sanjeev. Your team has done very thorough due diligence, and I had a Herculean time getting through the due diligence process. And after that, they have selected the fund, so it is already there on your stable.
Yeah. So, guys, there are a lot of these questions on the landscape, on economy. I'm sorry, I'm not able to take all the names. It's Sachin, Radhika, Mayur. A lot of people have asked these questions on the time. See, systematic investment plan is actually a tool which is made to take care of these things that of the economic uncertainties. Okay, so
Yeah,
you're coming in systematically so that you're able to average your cost. When the
yeah,
market is high, you get lesser units. When the market is lower, you get higher units. So over a time, it averages out, and so just guys, systematic investment plan is a no-brainer. Okay, so just that whenever you want to start investing, if you can do a SIP, you can, and you are ready not to look at the return for the next 5 10 years, then go for a SIP. Okay, on investments, again, I love a category called balance advantage. That's where almost 30 35% is debt, 65% is equity, lot of flexibility, quite a decent product to look at. And there are a lot of clients like Mayur is asking a question that can we evaluate your portfolio as Bajaj Capital? Yes, we offer this service. So my point would be that guys, this is a complimentary service. If you have your insurance portfolio, mutual fund portfolio, you want a research team to do a complete diligence on it, we offer it free of cost. Please write to care@bajajcapital.com, and you will have somebody get in touch with you. So this is, we are more than happy for the people. There are a lot of questions on how do I join Bajaj Capital or India Infoline Asset Management. So if you're joining Bajaj Capital, if you have experience in wealth management, please apply. You know, we are always looking at people. Even if you don't have experience in wealth management, then we have a program called IDWM. Search for it online. We train you. We make you do CFP, Certified Financial Planner. We take you through a very systematic training plan, and within 4 to 6 months, we make you into a wealth manager who's comparable to a person with 4 5 years experience. So please look at IDWM. It's a great way to make, and my team has put the careers website, so you can go to the careers website and see that this thing. Uh, so this is what it is about. Ananya, one more question is that people are asking a little bit more detail about the AIF you shared about. That why would it give a better return than the market, or what are the unique things you are doing in that AIF?
sure. Let me give one or two examples. I think then the people will be able to appreciate it very well. So we have a fund on this on the fixed income side, which we call the fund is an income opportunity fund, and this fund invests in the infrastructural sides, all the infrastructure projects and all. So there was an opportunity with an InvIT. InvIT is a basically platform for the infrastructure and all of that. So which was backed by a Canadian pension fund, CBDQ. Now, InvIT had got two toll projects, and it was just not possible for anybody to get hold of that because this would need a lot of commitment and all. With through us, we have got almost 17% stake in this InvIT. This is giving you an IRR of 15%. Right now, the InvIT is unlisted. The moment it moves from unlisted to private listed and a private listed to public listed, the capital gains will start coming in. Now, capital gains in the InvIT is basically attracts equity taxation. Now, this is a beautiful beauty product. You have a BOT project where you have funded, which is giving you an IRR of 15%. But you can actually make us even better money the moment you get this InvIT listed. And by virtue of getting it listed, the capital gain component will attract equity taxation. This might be sounding a little complex to the team out here, but these are the ways, when you can do a lot of structuring, which you otherwise cannot do it. Other thing is, you wanted to invest in Swiggy. You wanted to invest in one of those dream companies. How would you do it? For example, we were one of the largest holders of asset of NSE. We got into NSE at around 800 odd bucks through our private equity fund. Now, that time NSE was just not, people didn't have an access to that NSE. Now, today, NSE prices, we all know, despite the challenges on the IPO, still that has become a multi-bagger for many of the investors who were entered at that point of time. Through AIF, you can actually travel the entire journey. I'll give you a very classic example. Sanjiv comes up with a very unique idea, which he feels, look, this is a great idea, but I need capital. He can actually come to me. I can give him through an AI for seed capital. Now, seed capital, because I have entered with Sanjeev at a very, very early stage, the time horizon for this investment would be maybe 8, 9, 10 years. The same Sanjeev, when he does very well, he moves up on the curve, he again needs a fund. I can give him a mid stage funding where I can give him the money with a time horizon of 5 to 6 years, because right now he has moved outside the purview of seed, moved into a mid stage. Tomorrow, if Sanjeev wants to come with an IPO and he wants to do a last bid so as to get the best valuation for an IPO, I can even provide him money for that. That is what we call a pre-IPO fund, where holding period of the stocks are between 2 to 3 years. Now, through the AI structure, you have gotten access to Sanjeev's company right from the date of inception when he came for a seed capital, need, to the last leg when he actually wanted to go for a pre-IPO. Now, this is something that you will not be able to get anywhere else. So these are the advantages, whether on equity or on debt, where AIF can help you with.
Yeah, I think very well answered, Anunya. I think quite an you know well explained the whole concept of AIFs and why do they need to be a part of your portfolio, provided you're in that segment that
Yeah.
you can this thing. So last, guys, we are almost out of time, but the last question we'll take is that there are some questions about that there were a lot of debt redemptions in March. This is a question asked by Alok saying. So, whereas there's been a lot of inflow also in debt in the last 4 days where people have gone crazy, and how will this inflow and outflow affect the debt funds? Anunya?
So, you know what? I would say more than inflows and outflow, I think you should look at how this landscape is changing. Because inflow, outflow, whatever impact had to come is already there. But the beauty is the landscapes have changed completely. Till yesterday, tax arbitrage used to be one of the key determining factor between investing through in a debt fund or in a category 2 AIF funds. Category through AIF were having a marginal taxation. Debt fund, you can still command a 10 or a 20, depending upon whether you are looking at an indexation benefit or not. And hence, even if you get a 9% in a debt fund, by paying a 10%, you are able to pocket 8.1. While same 9% in an AIF, by virtue of 33% getting taxed, you are only able to get 630, 640. Today, what has happened is we are actually at a level playing field. Today, the advisories, rather than getting based on taxation arbitrage, has moved ahead and has looked into the risk onboarding and the coupon that those risks can give it to you. Keeping in mind, liquidity is one of the factors which I am being very, very clear from day zero, from the very beginning that that is just not there. You don't look at liquidity at all. But that's being a significant change that has happened in the debt market. While I think that's a subject in itself to discuss at length, because it has also done away with a lot of institutionalization that we could do in last 20, 25 years. Many things have got dismantled, so I think that's a separate topic to discuss. But to me, advisories landscapes have completely got changed after this new ruling coming in.
So one quick question we'll take is that how do we attract mutual fund investors towards FD investors towards mutual funds? Harish Rawat is asking this question. He's saying you have done everything, and we are out of time. But there's another very interesting question here, and this is a question which is on the mind of a lot of people. That I'm sitting on mutual fund and now I have got 70% return in the last 2 years. So isn't it a good time for me to exit rather than average my returns down and do a SIP? What should I do? So, Anunya, if we can have quick answers to these two questions.
So let me make an attempt to first. I think we are talking apple with oranges. See, please appreciate the very fact fixed deposit is a contractual agreement that you have done with a bank or a company, wherein a return is fixed. Your returns cannot be more than what it is being contracted for. But the moment you take a mutual fund route, there's something called a mark to market component which can add to your returns that what you can look for. And hence there is a possibility that you can earn better than what it is looking at what it is visible to you today, depending upon what is the interest rate view that you carry. That's one. Coming to the second part of the question on the on I have already accumulated enough returns. What do I do from here on? So I think my answers are very simple on this as well. See, please appreciate the very fact that what is my objective? If my objective is that I am looking for a certain goal, which could be the retirement, education, which could be the family marriage, or whatever, it's a journey that you are traveling. If this wealth wouldn't have got accumulated, then I would rather say the team of Bajaj Capital haven't done a good job. Because they have done a good job is the reason that your 100 actually have become 170 today. But your goal is what? Your goal is 300. Why are we talking on the journey to now? What should I do? And the last part of the question is, what do you want to do with the money? Okay, fine, take the money out. What is the reinvestment risk that you carry? There are enough evidences or there are enough studies which has been done that timing the market has never helped. It is spending time in the market which has resulted into the compounders. I am very happy for the gentleman who has raised the question. That means the advisor who is advising him, he has done a fantastic job. Please pat on his back and allocate more money to him rather than thinking of withdrawing the money.
Yeah. And also going in, there was a question asked that how often should you get your portfolio review done? So, guys, you should get it done, if you're a large investor, once a year. And if you're a smaller investor, then once in 2 years is a kind of time. And when you do that portfolio review, there will be some funds where we feel that there's no steam left or it is going to take time. So you will get that advisory. So thank you, Ananya. I think a very, very interesting conversation. And I hope we have been able to add value and, to our viewers today. And thank you for taking out time, coming and joining us. And we are very excited to look forward to IFL products. And we look forward to, a great performance from your fund.
No, I think many thanks to you, Sanjeev, and many thanks to the audience who took out time to patiently listening to this conversation. And I must say that you have built in a fantastic franchise. And I remember talking with Rajiv and he telling me, Anunay, ours is one of the organization which can talk about managing at least 5 generations. Now, I don't think how many institutions can talk about transiting through 5 generations, and yet the fifth generation is with you. I think that speaks volume of the franchise that you and Rajiv have built in together. And I must congratulate you and your entire team for doing the fantastic job. We love your patronage and believe you us. Our commitment to this franchise is more than 100%.
Yeah, and for me also, guys, one of the most figures we are most excited about that 90% of our clients stay with us for more than 10 years. So, the point is that makes us proud because this is not a one day match. It's a long term journey. Investments is not a destination, it is a journey. And it's a very exciting journey. So, start your journey, and we look forward to creating value with you together. And thank you, Ananya, for taking
I
out
just
time.
wanted to I just wanted to say one thing, because it's Bajaj Capital, I'm just getting excited to talk about it. This is one institution which has actually defined alternate investments. And why am I saying so? The what used to be alternate, which is the mutual fund, till couple of years back, from an FD to mutual fund was an alternate investment. Today we are talking about mutual fund to an alternate, which is a REIT and InvIT. So I think fantastic job done by you and your team. I think you guys have really defined an alternate investment, what it really means.
Thank you, Ananya. Thank you, and thank you everyone for joining us today.
Sure. Thank you.